This is Wall Street saying the quiet part out loud. Bitcoin is too big to ignore, but they'd still prefer to intermediate your exposure. Let's break it down. So JPMorgan's new structured note uses BlackRock's IBIT ETF as the underlying asset. If IBIT is flat or slightly up by 2026, the note auto calls and the investors get a fixed 16% return. But if IBIT is down in 2026, the note still stays alive until 2028. And if Bitcoin explodes by then, the investor gets 1.5x leveraged upside with no cap. JP Morgan is offering institutions a smoothened form of Bitcoin, lower volatility, capped risk, derivative based, and with downside protection as long as IBIT doesn't fall by more than 30% in 2028. In exchange, JP Morgan harvests spreads, takes the cheap optionality, and captures the actual raw upside of Bitcoin. This is Michael Saylor's model, but through the lens of TradFi and being done at the world's largest and most important bank. Instead of corporates issuing convertible debt or preferred stock to buy Bitcoin, JP Morgan is issuing derivative debt backed by Bitcoin's performance. It's the same realization that Saylor had in 2020. Bitcoin is the world's best performing monetary asset, and fixed income is structurally incapable of keeping up with monetary debasement. The difference is that JP Morgan isn't buying Bitcoin, it's monetizing the demand for it. And here's the massive point that nobody is talking about. If the world's largest bank is building Bitcoin-linked structured notes and has stated previously that it intends to accept Bitcoin as collateral, Bitcoin is breaking into the global bond market even more so than it has done for the last year with Strategy's preferred stock. Even a tiny allocation becomes seismic. Let's run the math.